Good afternoon, everyone, and a very warm welcome to all the participants who have joined us today for today's webinar on SA 550, which is on related parties. In this session, we will discuss the key auditing considerations, disclosure requirements, and compliance aspects with respect to the related party transactions. For this session, we are privileged to have with us CA Dr. Chinnaswamy Ganesan, sir. Good afternoon and a very warm welcome to you, sir. So now I would like to introduce our speaker, CA Dr. Chinnaswamy Ganesan, sir. He is a fellow chartered accountant with over 36 years of experience in auditing and financial reporting. He has served Indian and multinational clients across diverse sectors and having held senior positions such as director in Deloitte, director in PwC Network Firm, and audit partner at BSR and Company LLP. Dr. Ganesan is currently the managing partner of RKCJ and Associates LLP and has presented over 1400 papers at international and international forums. He has guided more than 80 companies in India's transition and authored several books on financial reporting and Companies Act 2013. Dr. Ganesan also serves as an independent director and chairman of audit committee at leading institutions like Karur Vysya Bank and Wellstar Microfinance Limited, and has previously been on the board of Railtel Corporation of India Limited. He has been deeply associated with Institute of Chartered Accountant of India for over 2 decades, contributing to various committees including Accounting Standard Board and Auditing and Assurance Standard Board. He is much sought after speaker and faculty member at ICAI, RBI Staff College, CAG Regional Training Institute, Institute of Cost Company Secretary of India, Institute of Cost Accountant of India, CII, FICCI, and leading business schools including IIM Bangalore and IIM Lucknow. So now I request CA Ganesan sir to start this session on SA 550 and share the valuable insights on this standard, sir. Over to you, sir.
Thank you. Thank you, Vivek. Thank you, WSP Chairman and the Vice Chairman for giving this opportunity of discussing one of the most important area in audit, because all the regulators are talking about related party transaction as one of the key areas where the audit failures are happening. So accordingly, when we talk about the standards on auditing, we should also look at what exactly is the related parties, how we will be doing the audit, and what is the disclosure, what is the compliance. So when we look into our standards on auditing, it gives elaborate guidance on how to do an audit, how to disclose and compliance. And however, when we are talking about the compliance and disclosure aspect, I believe that we should understand the various regulatory framework within which related party transactions are getting covered in an audit process. For example, if I do an audit of a company, naturally under the Companies Act, related party transaction comes as one of the requirement. So the disclosure also comes as part of either AS 18 or Ind AS 24, depending upon what is the financial reporting framework that particular company is following. Similar to that, when we were looking at this, when I do a tax audit of a client, I should look at the aspects relating to how the transaction with the related parties are considered both in India and in respect of international transaction, either under Section 48(2)(b) of the Income Tax Act, where we were saying whether the payments made to the related parties are arm's length or in excess of the arm's length or market price. To that extent, the assessing officer has the right to disallow, or he has an entitlement to disallow at his discretion the excessive payment. Similar to that, under international transaction, when we were looking at the transfer pricing comes into the picture, Section 92F and related provisions is also looking at whether the related party transactions are at arm's length. And accordingly, if it is not arm's length, naturally, there is a primary adjustment which comes under the transfer pricing regulations. So accordingly, it is not only to look at the Companies Act or just Income Tax Act or any other thing. we should also understand what is the responsibility of the auditors in relation to audit under the Companies Act, audit under the Income Tax Act, audit under transfer pricing regulations, etc. And accordingly, the definitions and the expectations of the auditors should be aligned with the guidance provided in our standards on auditing on related party transactions. That is the way in which I have structured the entire discussion. So accordingly, you will be able to appreciate that this is going to helpful not only for the company audit but also for your tax related audit work at this point in time. Okay, so you can actually send your queries in the chat box, which I will try to answer during the course of the presentation. Or if the question is relating to something which I'm going to cover at a later point in time, I will take it at the appropriate point in time. If too many questions are coming in, maybe the timing may be an issue. I actually reserved 15 minutes for interaction between the participants answering all the questions. So it's a 2 hour discussion between 2 to 4. So around 3:45, I will stop the presentation and then we will have the question and answer sessions. Accordingly, at that point in time, whatever I have not answered during the course of my presentation, I will answer that. One of the structure in which I normally do the presentation is I try to cover what could be the possible frequently asked questions or what could be the possible doubts which we may have in our mind as an auditors, or sometimes what is the expectations of the regulator in certain areas. So if those answers are same like what you are asking for to get clarified, those items also I will leave it at the end of the session. Only those unanswered I will take it up. So this is the way in which I have structured. First of all, let me go into the definition or the related parties, how the coverage is actually happening with respect to the related parties under various regulations. That's the way in which I will start doing it. So one is under the Companies Act, there could be possible levels at which a related party or the relationship starts coming in. Company with another person, how they are getting related, company's key management personnel, and how another entity or another person is related because of the KMP's relationship. And lastly, through the individual level, what is the relationship? This is under the Companies Act, we can understand all this, the relationship can be put in 3 buckets to understand in a easy manner. The second is, it is not only section 188 of the Companies Act and the Companies Accounting Standard, Companies Act 2013 and the rules thereon, but also in case if we are talking about a listed company, SEBI's listing and other disclosure requirements, regulations, 23 read with Schedule 5 also requires certain parameters of reporting and compliance and disclosure of related party transaction. For example, SEBI requires that the audit committee should consider the related party transaction and then assess whether it is at arm's length price. If it is an arm's length price, it can approve, or if it is not an arm's length price, it will send it to the board and the shareholders appropriately for them to consider. And apart from that, we also have the compliance with the accounting standards. AS 18, if it is a company not covered under your Ind AS, or Ind AS 24 if the company is reporting under Ind AS. These are all the laws relating to related party transaction, which the standards on auditing is trying to help us in guiding through the entire audit process. And of course, even though we are talking about the compliance under the Companies Act, SEBI or accounting standard, in the preparation and presentation of financial statement, majority of the client is also required to consider income computation and disclosure standard as well as the various regulations of the Income Tax Act, which deals with the transfer pricing regulations as well as the transactions with the related parties with the entity. So accordingly, we should consider that also as a framework for doing the entire process of auditing the related party transaction. Before I proceed further, I should also tell you that there is a direct linkage with the related party transaction with the SA 240, which is nothing but consideration of fraud risk in an audit of financial statement. As you recollect, even though we are trying to say auditors are only a watchdog and they are not bloodhounds, the requirement of SA 240 is very categorical, which says that during the course of audit or during the performance of the audit, the independent auditor should consider the susceptible areas of fraud risk and have an audit procedure to address those areas. Two areas are presumed to be fraud risk area, irrespective of other risk which you have identified during the course of your audit as per SA 315. Two risks under SA 240 is considered as key risk. One, revenue is considered to be susceptible to fraud risk. The second is related party transaction. So that the moment you have a very clear guidelines that the related party transactions can result in a fraud risk, which may affect the financial statement materially, the audit procedures required to be followed by the auditor and the various disclosure and requirement of compliance has to be meticulously followed by the auditor, and the documentation required should also be properly maintained. Otherwise, your audit may not be in accordance with the standards on auditing. And when the regulator is reviewing your work papers, he may conclude or they may conclude that your work is not enough. And you may also recollect, NAFA believes that majority of the accounting frauds revolve around related party transactions only. So they are questioning the related party transactions, whether it is approved in accordance with the law, whether the transaction is arm's length, how the auditor has got the comfort that these transactions are acceptable to him, and he got the required audit comfort to give a clean report on related party transaction. So with this framework, we should understand this is a key area of audit, and that is the reason why a separate standards on auditing is being given by the Institute of Chartered Accountants of India for doing the audit of related party transactions. Okay. So with this framework, let us look at the related parties under the Companies Act 2013. I said there are three levels, right? The first level is company level. One company may be the holding company of another company. One company may be a subsidiary of another company. One company may be a fellow subsidiary of a company, and both the companies are under the same holding company. And there is a possibility that it may be an associate company. You may also ask why joint venture is not considered here. The idea is joint venture normally covered as a joint control, and that is also considered as a related party, but there are certain specific exemptions which are being allowed on those items. The second level to understand the related party transactions under the Companies Act, first we have to determine who are all the related parties at the management level. So there are three levels of management which you have to consider. Key management personnel are the directors. That's the two people. And naturally, the relatives of the key management personnel or the relatives of the directors are also considered as part of the management level related parties. Over and above that, in case if there is any body corporate which has an influence over the key management personnel or on the directors, but not on a professional capacity, non-professional capacity, that is also considered as part of the related party transactions. Now, let us look into how the relative or the other entity will be related at the management level. That is the directors key management personnel or the relative of that director or the body corporate, right? So let us understand that. First of all, it may be control, it may be joint control, or it may be direct influence or indirect influence. So you know that control, significant influence, and joint control are the three important terms to determine the related parties and the relationship, and based on which only we will do the next level of audit procedures under the standards on audit. So in this case, suppose if it is if a director is a partner in a partnership firm, then that firm is also considered as a related party to the company. If the key management personnel is a partner in a partnership firm, again that firm will be considered as a related party to the company. In case any relative of the directors or key management personnel are partners in a partnership firm, again that partnership firm will be considered as a related party for the reporting entity. Similarly, if a director is a director in a private limited company, then that private limited company is also considered as a related party for the uh, reporting enterprise. Similarly, a key management personnel is a director in a private limited company. Again, it is the private limited company is a related party. If the relative of a director or key management personnel is a director in a private limited company, in that situation also, that private limited company is considered as a related party to the reporting enterprise. There is a small change compared to private company and public company when it comes to directorship, right? So, for example, if a director or key management personnel or relative of the company or the reporting enterprise is a director in a private company, automatically the private company becomes a related party, as we have discussed earlier. Suppose if the director, key management personnel, or relative of the director or key management personnel is a director in a public company, what we are supposed to look at whether the director holds at least 2% of the share capital, or maybe I can say more than 2% of the share capital of the public company. If the shareholding of the director is lower than 2%, then the public company will not be considered as a related party. Otherwise, at the management level, that also considered as a related party. The first level is company level, second level is the management level. We have identified who are all the related parties under the Companies Act. Third is the individual level. For example, if I'm looking at, so when there is a director, then the director being an individual or an individual is having a control or significant influence on the enterprise, then what will happen is who are all the other relatives who has to be considered, relative of the director, relative of the key management personnel, who are all the persons who are considered as a relative of such individual. One is grandparents, parents, and Hindu undivided family, in which the individual is actually a member. So, grandparents, parents, and HF, spouse, children, and grandchildren. So, two aspects which you can consider here is linear ascendant and linear descendant are covered. Grandparents, parents, children, grandchildren are fully covered. Spouse is covered. HUF, in which you are a member, is also covered. Whether this is the entire coverage of the related parties under the individual level, let us go one step further, because they say, as per the rules relating to the Companies Act, they also say parents include step parents. So that means it not just lineal ascendant and descendant, step parents, if it is there, it is also considered. Children include stepchildren, son's wife, even though it is not considered as part of lineal ascendant or descendant, son's wife is specifically covered. Daughter's husband is covered. Brother, including stepbrother, is covered. Sister, including stepsister, is covered at the individual level. So that is interesting to understand at this scenario. So, company level, management level, and individual level, who are all the related parties. If you look into this, almost all the parties will be considered as related parties, where it comes to brother, sister, son's wife, daughter's wife, children, stepchildren, parents, step parents, grandparents, grandchildren, everything has been fully covered. Now, when we were trying to identify which company is a subsidiary company, there are two parameters which we normally look at. A holding company, for example, I'm taking company A is the holding company. It owns or controls more than 50% of total voting rights or board control. Then, assuming that it's in company B, then company B is considered as a subsidiary. Let me debate on this particular aspect. Not only ownership, but also controlling the voting rights is considered. And not only board representation, but controlling the board representation is also covered. Now you will understand under AS 18, we normally say control exists where it's a presumptive assumption. Control exists where 50 more than 50% of the shareholding is held by one entity in another entity. But now, when you are looking at either ownership or controlling more than 50% is comes as far as the shareholding is concerned. This is mainly because when you look at India's 24, India's 24 says you may be holding only 10% of the total voting rights. At the same time, you may indirectly control how the other shareholders, say for example, another 50% of the shareholders, how they will vote, you are indirectly controlling them, or maybe you have a side agreement, you have an agreement with them, etc. Or maybe you are the owner of a technical know-how within which the company is actually doing its business. In those cases, you may have a shareholders agreement which gives you a control over the voting rights more than 50%, even though you actually own only 10% of the total voting rights. So ownership or you have the control over more than 50% of the total voting rights has to be first considered. The second consideration is board representation. Assuming that there are 5 directors and one entity, company A, has the power to appoint, say, for example, 3 directors in that. Naturally, the entire decision of the company is being done by the board, right? Financial and operating policy. So to that extent, company A, through its board control, can control over the financial and operating policies of the entity. And because of that, company B will be becoming a subsidiary. So ownership, uh, control of the voting rights and board representation. This is point number one. Point number two, for establishing as a subsidiary company. Say, for example, holding company A owns or controls 50% of the total voting rights or board control, which we have seen in the scenario. Company C becomes a subsidiary, or company B is controlled by company A. Let us assume the first point which we have considered. Company A has ownership or controls more than 50% of the total voting rights. Because of that, B becomes subsidiary. And B in turn owns or controls more than 50% of the total voting rights, or company B can control the composition of the board of directors of company C. Then company C is also considered as a subsidiary of company A. This what we call it as company A is the ultimate holding company, company B is an intermediate holding company, and company C is the step down subsidiary of company A. Company B and company C are fellow subsidiaries of, sorry, not fellow subsidiary because it's a step down subsidiary, control is there. There could be another scenario that company A holds and controls company B as well as company C. In that case, control is existing in every scenario, they are considered as fellow subsidiaries in a different perspective. Subsidiary is what is this composition: direct control, direct ownership of the voting rights, or through another subsidiary, you have the voting rights or board control, then the subsidiary relationship comes into the picture. So the controlling, in case if somebody is controlling the reporting entity, then that controlling entity is called a parent company or could be a ultimate parent company. For example, in the position A, company A becomes a parent company. In the scenario 2, company A becomes the ultimate parent company because it's the parent company for B and B is the parent company for C. For C, ultimate parent company is company A. Okay. Suppose if the reporting entity is controlled by the reporting entity, then that becomes a subsidiary. For example, in this case, if we are considering the reporting entity is company A, then it is controlled, it is controlling the reporting entity, which is company B. Both are related parties. So company A becomes parent company or ultimate parent company in the case of company C. Whereas company B and company C are controlled by the reporting entity, assuming that A is the reporting entity, then in that case, they are subsidiaries of A. Under the common control is another situation which is possible where holding company has investment in A as well as subsidiary A and subsidiary B. Then subsidiary A and subsidiary B are considered as fellow subsidiaries. This is to identify how the subsidiary companies are coming in. So now the question comes, as per the auditing requirement, what are all the things which you have to consider? First point which we have to consider as part of our audit procedure is to understand whether the definition of related party under the accounting standard, under Ind AS, under the Companies Act, sorry, under the Income Tax Act are all same or there are differences. That is the first thing which you have to see. In other words, I can say, depending upon what is your reporting requirement. For example, if my reporting requirement is under the Income Tax Act, I'm not worried about what accounting standard says or what Ind AS 24 says, right? Because my reporting requirement under the Income Tax Act is based on Income Tax Act requirement. So the related party definition under the Income Tax Act we have to see. Suppose if my reporting responsibility is a statutory audit or a limited review or audit of a subsidiary of a parent company for which a group audit instruction I have received, etc. In those cases, because I am reporting under the Companies Act, I must understand what is the definition given under the Companies Act, what is the definition given under Accounting Standard 24, what is the definition given under Accounting Standard Ind AS 24, right? So all these are considered to be very critical. For your information, all the definitions are different. For example, when I'm talking about AS 18, AS 18 is not going beyond the shareholding pattern or the composition of the board of directors. But Ind AS 24 very clearly says shareholding pattern is the starting point, but at the same time, you have to see what is the power or rights the other shareholders are having, whether they are non-controlling interest or they have controlling interest. So the fundamental principle itself is completely different under AS 18 and Ind AS 24. Income Tax Act also talks about related party in a different perspective, not exactly in line with the accounting standard. And accordingly, as I have said, based on the reporting framework, you have to have a different perspective for identifying and understanding the related party transaction, and then start your audit procedure as given in our standards on auditing. As I have already covered this, AS 18 and Ind AS 24 also, the definitions are different. Again, the definition of control and significant influence, is it different from the definition given in As and Ind AS. For example, when we are talking about controlling enterprises or the entity which is having significant influence under the Companies Act, whether the same is the definition given in accounting standard, whether it is the same definition given in Ind AS, there are differences, which I will try to cover at a later point in time. So the starting point for us is to identify the related parties. And for identifying the related parties, we should understand what is the reporting requirement under which we are carrying out our assignment. And for that engagement, based on the reporting requirement, identify the definition of the related party, then start identifying the related party. Then only we are moving to the transaction with the related party. Okay. When we were talking about transaction with the related parties, we should understand what are all the transactions covered between the reporting entity and its related party. First of all sales, purchases, and supply of any goods or materials are fully covered. So it may be traded goods, it may be raw material, it may be consumables, whatever. Sale, purchases, or supply of any goods or material is fully covered. Selling or otherwise disposing of or buying of property of any kind, mobile property or immovable property, buying or selling, that is also fully covered. Leasing of property of any kind. So you may enter into an operating lease or finance lease. That transaction is also fully covered under the related party transaction. So the first point which we talked about, sale, purchase, and supply of any goods or materials. Similarly, any sale, or instead of using the word sale, I'm saying rendering of any service. Instead of saying purchase, I'm saying availing of any services from one party reporting entity with another related party is covered. Appointment of any agent for the purpose of purchase or sale of goods, materials, services, or property. If you have appointed any agent, that transaction is also covered under the related party transaction. Appointment of any office or place of profits in the company. So place of profits means salaried employment is also place of profit, not only in the company, in its subsidiary company, in its associate company. The only thing which is not covered is if the appointment to any office or place of profit in a joint venture company, that is not covered as a related party transaction. Underwriting the subscription of any securities or derivatives thereof of the company. So this is whether it is an exhaustive list of the related party. The answer is no. This is illustrative or the transaction which are getting covered. So whenever we are seeing that there is some transaction between the related party and the reporting enterprises, first audit procedure is whether it is getting covered in any of this. If it is not getting covered, most likely it will get covered here. If it is not covered under any of these items, we should also look at whether it is a transaction to be considered for arm's length between the reporting enterprise and the other party. So whether this requires a transaction to be covered under the Companies Act, Section 187, 188 of the Companies Act also, we have to look at. Income Tax Act means 48(2)(b, you have to look at. Okay. But the interesting factor of the Companies Act is that in case if there is any unauthorized contract or transaction with the related party, the penalty is rupees 25,000 rupees to 5 lakhs. And it also comes with a bonus with or without 1 year imprisonment. Interestingly, there is a situation. You may say, by entering into the transaction, I have not made any profit, I have incurred only the loss. Then that should also be covered. That means by entering into a transaction with a related party, if I have incurred a loss, that loss should also be recovered from the related party because the transaction was not at arm's length price. Otherwise, you may not have entered into a loss. Okay. So this is framework of the transaction with the related party. Is there any related party transaction which we can consider as exempted from the coverage of the Companies Act or the accounting standards, as the case may be? Here, let us look at the Companies Act, Section 188, subsection 1. What it says is that nothing in Section 188, subsection 1, that is related party transaction regulations, shall apply, nothing shall apply to any transaction entered into by the company in its ordinary course of business. Point number one. Point number two is that transaction entered in the ordinary course of business should be arm's length basis. That's the reason why the continuation says other than transaction which are not on arm's length basis. That means those within arm's length basis and also considered in the ordinary course of business are considered as an exempted transaction. Let us take a simple example. If the reporting entity is operating, say, for example, a logistic division, transportation of goods and services, one of its related parties is availing that services and paying for that. So in that case, the logistics is a business or the ordinary course of business of the reporting entity. And accordingly, when it enters into a transaction with the related parties also, that is not considered as a transaction to be reported because it's an exempted transaction. But at the same time, what is important in the case of ordinary course of business is that the transaction should be arm's length. For example, in the same transaction, logistic services are provided to a related party at a price lower than what is the price at which it will be given to any other third party, then it is not arm's length, then it is covered under section 188. If it is in arm's length, on arm's length price, and it is also in the normal course of business, then to that extent, this transaction is exempted from the coverage of section 188, and accordingly, we need not do any specific audit for the related party transaction. Because of this, only this transaction will come to the audit committee if the audit committee is there in respect of the company. And if so, the audit committee will note this and will also confirm ordinary course of business, arm's length price. And accordingly, no further approval is required by the board of directors and shareholders. In other words, from the second bullet, you can understand that if the transaction is not in the ordinary course of business, or if the transaction is in the ordinary course of business but not on arm's length price, then such transaction should be definitely considered by the directors and shareholders of the company based on the nature of the transaction. As some of them are getting covered within the board level, some of them are going to the shareholders level. We will see that also as part of our discussion. What is the exemption available for a private limited company in respect of related party transaction? Because it came based on an amendment happened by MCA notification in June 5th, 2015. So based on that particular circular, if a transaction is proposed to be entered by a private limited company with its holding company or subsidiary company, associate company, or subsidiary of its holding company, that is a fellow subsidiary, then no approval is required under section 188. Because what they are saying is you are doing the transaction within your group, holding company, subsidiary company, associate company, or subsidiary of its holding company. For the private limited company, you need not get them formally approved by the audit committee and board of directors. There is an exemption which has been given. Suppose if the counterparty is a public company, then the counterparty will be having the compliance requirement of section 188 because the exemption is only for the private limited company. If either of the party is a public company, that's a holding company or subsidiary company or associate company, or subsidiary of the holding company is a public company, then naturally that counterparty, that is that holding company or the subsidiary company or the associate company or the subsidiary of the holding company should comply with Section 188. That means it has to again say whether the transaction is at arm's length price, whether the transaction has been carried out during the ordinary course of business. That compliance comes into the picture. Interestingly, for a private limited company, they have given one more exemption. If there is a resolution which is going to be passed for a related party transaction, a contract is going to be approved, or the arrangement with the related party is going to be approved, normally we will consider the related party as an interested party. But here they are saying the related party who is a member, shareholder of a private limited company is eligible to vote on ordinary resolutions. That means special resolutions, that shareholder does not have any power. But if it is an ordinary resolution, then he can pass or he can vote on that particular transaction. And there is no restriction on he doing the voting or casting his vote, right? This is exemption is available only for private limited company with respect to related party transaction entered into. So what are all the focus points for our audit? Or what are all the areas where we may require clarification? Let me first look at this scope of the provisions, existing provisions of the related party transactions have also includes selling, buying, and leasing of movable and immovable properties. So previously we were only talking about selling of goods and services or availing of goods and services. Now with the availing of services. Now we are also saying the notification has also extended the coverage of the related party transaction. Interestingly, an arm's length transaction entered into in the ordinary course of business is an exception to the related party transaction rule. That's what we have seen in the previous slide also, where we say if the transaction is in the ordinary course of business as well as where the transaction is held on arm's length transaction, arm's length basis, we have said that it is an exempted transaction under the Companies Act. So no audit procedure specific to related party transaction under our standards in auditing is required to be applied. The shareholders' approval for non-cash transaction with directors of the company, its holding company, or its associated company, or a person connected with him would be required. This is something interesting. You might have seen that in your main audit report also, we are asking whether there is any non-cash transaction entered into with the directors of the company. That is one of the questions which is coming in the main audit report itself, right? So what is non-cash transaction? Anything which is not being settled by means of cash or cash equivalent. Then all those things are non-cash transaction. For example, providing a perquisite could be a non-cash transaction. Or giving a gift in kind could be a non-cash transaction. So all those items are getting covered under the requirement of audit, and shareholders' approval is required for those transactions. Okay. So with whom I have to enter into non-cash transaction? Not only the directors of the company, directors of the holding company, directors of an associate company, or any person connected with such director of the company, such director of the holding company, such director of the associate company is also considered. As you observe again here, holding company is considered, associated company is considered, but not joint venture company. Okay, because it's a joint control. That's the reason why they believe like that. Let us also understand what is the approval process under the Companies Act. So first of all, whether the particular transaction is with the related party. If I say no, whether it is a specified transaction. When I say transaction is not specified, whether the transaction is held in ordinary course of business. When I say no, whether it's the transaction is arm's length, whether the transaction is held in ordinary course of business, then I ask, it is not in the ordinary course of business. I am asking the question whether it is in arm's length price. If I say yes, no prior approval is required. Even if the transaction has happened in the not in the ordinary course of business, if the transaction are happened at arm's length price, no approval is required under the Companies Act for the related party transaction. Let us look at the other aspect. If it is a specified transaction, yes, no further transaction is required. Suppose if I'm saying whether it is a transaction with the related party, if I say whether that transaction requires a further action or not further action. If you see, in the normal course of business, if the transaction has happened, then nothing to worry about that. Okay. If it is other than arm's length transaction, what happens is we are looking at whether it is a specified transaction. If it is specified transaction, that is specified amount, transaction beyond a specified amount or capital is more than 10 crore, then the shareholders approval is also required by ordinary resolution along with the board approval. If it is transaction is not beyond the specified amount or the paid up capital of the entity is less than 10 crore, then board approval is enough. So this is a simple understanding of the approval process. Now, when the shareholders' prior approval is required for related party transaction by ordinary resolution, let's look at that. One thing which we have seen, if the share capital is 10 crore or more, then shareholders' approval is mandatory. If it is sale of goods and it is more than 10% of the total annual turnover or rupees 100 crore, whichever is lower, then in that case, to a single related party, in that case also shareholders' approval by ordinary resolution is required. Similar to that, sale of services, only thing is annual turnover or 50 crore, whichever is lower, 10% of annual turnover or 50 crore. In respect of goods, 100 crore. In respect of services, 50 crore. Sale or purchase of property more than 10% of the net worth of the company or 100 crore, whichever is lower. So purchase of property or sale of property means we will look at the net worth, whereas sale of goods and services, we will look at what is the related annual turnover to arrive at the 10%. Underwriting commission, more than 1% of the net worth. Similarly, appointment of a place of profit, more than 2.5 lakhs per month in the company or its subsidiary or its associates are requiring prior approval of shareholders through an ordinary resolution. This is again the approval process required. What are all our checkpoints for audit? The first is to check whether payment of commission to non-executive directors be treated as a related party transaction. So you know that the executive directors will be paid remuneration or maybe profit by way of commission on profits. Remuneration by way of commission on profit, both can also be given to the executive directors. Non-executive directors, for example, independent directors who are getting sitting fees, and other than that, they are not entitled for any remuneration, but at the same time, they are entitled for commission on profits of the entity, subject to restriction under the Companies Act, restriction under the RBI regulations, etc., depending upon what is the nature of the company's business. If it is NBFC or bank, then we have to look at the RBI guideline as well. So if the payment of commission is to a non-executive director, whether it is considered as a related party transaction. There is a divided view on this, especially on In respect of audit, we have to continue to do the audit according to the standards on auditing. But respect to disclosure requirements, there is a debatable point, or I can say divergence I could observe in the disclosure. Non-independent director means he is not independent of the company. So accordingly, whatever you wanted to consider is perfectly all right as a related party transaction. But if you are entering into a transaction with an independent director, which is nothing but payment of commission, whether that is also considered as a related party transaction, one view is that the moment you say the independent director is a related party covered under AS 18 or Ind AS 24 by means of control or significant influence, etc., then he loses his position as an independent director. He comes as a non-independent director only. And accordingly, to my mind, that is one school of thought or one practice which is being followed is that sitting fees paid and any other commission paid to non-executive independent directors are not covered under related party transaction disclosure. But of course, the audit you have to necessarily do whether the commission is in accordance with the provisions of the Companies Act 2013 or not, and whether that amount determined is also correct according to the rules thereon. Right? That is with respect to payment of commission to independent directors or non-executive directors. That is one school of thought says that it is not related party transaction. Otherwise, if you report that as a related party transaction, then how they can be independent? The second people are saying as an abundant caution, any director who has a control, any person who has a control, any KMP is considered as part of this. So I will consider that he is part of the board who can control the financial and operating policies, and to that extent, we will cover them also as related parties. One school of thought, the second school of thought. But my view is that the first point seems to be valid, that non-executive directors or independent directors are not considered as a related party because the moment they are called a related party, independence is questioned, right? That's point number one. Point number two, suppose if it is not considered as a related party transaction, but that particular agenda comes in the board meeting, whether the particular person who is a non executive director has to vacate the boardroom till such time that particular agenda is considered, or can they participate on this item of the agenda as well? Here, our professional judgment and professional skepticism goes into place. Even if we say that it is not a related party transaction, but anything relating to my payout, anything relating to my appointment, anything relating to my consideration as with additional powers, etc., the particular person who is going to get benefited out of it, the logical conclusion is he should not be part of the discussion, and accordingly, he should not participate in the agenda. But interesting point is he can be there in the board meeting, but can say, I am abstaining from the discussion because I'm an interested director here. So that could be the way in which we have to look at this. He need not vacate the room, but at the same time, he cannot participate on the item of agenda. Let us assume that in another scenario, there is a nominee director. That means I am one of the shareholder who is considered as a related party of company A. But I am not able to attend the board meeting, so I have appointed a nominee director or an alternative director in my place to present at the board meeting where a related party transaction is being considered. Whether it is possible to nominate to have the nominee director present at such scenario. Is more or less similar to previous scenario, situation where we have considered, but only difference is in the previous scenario we were talking about non-executive directors, whereas in this case we are considering a normal director, and accordingly the nominee of the related party should not be part of the meeting for that particular agenda point. After the agenda has been voted out, he can come and join back on the discussion. Suppose if there is any salary or remuneration which is being proposed to be paid to a director amount to a related party transaction, because the remuneration, let us assume it's in the normal employer-employee policy of the company, he is also getting the same level of salary or same level of remuneration. So when in that case, whether it's a related party transaction, so whether it is considered as a normal salary, whether it is considered as an excessive salary, whether you call it as a remuneration, whether you call it as a salary, nomenclature does not make any change. That is considered as a related party transaction because a director is considered to be a key management personnel as well. Director is also covered, key management personnel is also covered. So accordingly, salary proposed to be paid is also considered as part of related party transaction as well. So let us look at what is the interplay between Companies Act 2013 and the Income Tax Act. First thing is these various sections where in which the related parties are getting covered and where the auditor should be cautious in applying the standards on auditing is section 2 subsection 22E of the Companies Act. You know that section 2 not Companies Act, Income Tax Act. So you know pretty well section 2 subsection 22E deals with deemed dividend. That means any loan or advances in the nature of a loan are paid to a person who has substantial interest in the company, or they are an entity which has substantial interest in the company, etc. That is the definition. It said that that transaction, section 222 subsection E, covers those transactions as part of that. It is considered as a deemed dividend given to the recipient of the particular transaction. So whether section 2 subsection 22E will apply to all the companies? No, it applies only a company in which public are not substantially interested. That means private limited company. But as a public company, this section is not applicable. Private limited company, naturally, you have to consider always what is the transaction with the directors of the entity, and that should get covered under the Income Tax Act. Again, section 48 to be, you know that as I have started with talking about, any excessive payment made to the related parties in the opinion of the assessing officer can get disallowed under section 48 to be. Excessive payment more than the market price. So it's a discretionary power for the income tax officer, and accordingly, it doesn't prohibit that you should not enter into a related party transaction at all. Enter into a related party transaction, but report the transactions or disclose those transactions under 48 to be under the Income Tax Act. There is also another section, 56 to 10 of the Income Tax Act, which believes that certain transactions, if they are structured in such a manner, we have to unveil the particular shelter given in that particular Income Tax Act provision, but we have to invoke the requirement of 56 to subsection 10. So, based on which you will decide whether the transaction should be covered. To understand this further, I am actually I have prepared and presented a additional guidance for you. This slide I will share with WASB, which will host it in the portal if I'm not wrong, and you can download from there. Individually, I'm considering each and every aspect of the relationship and whether that is covered under AS 18, covered under the Companies Act, covered under Income Tax Act. So this may be an easy chart for you whether to get covered, whether you have to do an audit of this or not. Okay. So this is coming from where? It's coming from a simple process of identifying the related party in accordance with the Companies Act. Under the Companies Act, we are also saying it may be at the company level, or it may be at the management level, or it may be coming under the individual level. The management level, when we are having all these joint ventures, associates, subsidiaries, etc., we will consider how the transactions is happening with the director of the company, with the key management personnel of the company, with the relative of such director or such key management personnel. For that purpose, this slide will give you a complete guidance and see the category given under the Companies Act 2013 for that purpose. Okay. Interestingly, AS 18 is a disclosure standard. It is not an accounting standard, even though we call it as an accounting standard. When I say accounting, I recognize, remeasure any of the items of an asset or liability or corresponding income or expenditure, then only I will consider that they are covered. Okay. So under AS 18, the related party transactions has to be considered on three aspects: whether the entity has control over the other entity, or whether the other entity having control over the reporting entity. Both the sides you have to see. So when we were looking at this, the next point which we have to consider is under the Companies Act, what is the definition? If you see, everybody is covered under the Companies Act. Income Tax Act also almost the there should be two. Right. So what we have to consider is mother's mother is not covered under the Income Tax Act. Father's mother is covered, father's father is covered, but mother's mother. So that is the if you are, we are talking about maybe I will take an example of myself. The transaction with my mother will consider to be related party transaction, but my father's mother, if I have entered into a transaction, are not covered. So mother's father, Companies Act covers everybody. Daughter's husband, accounting standard is not covering that, but Companies Act 2013 has included them also as related party. Okay, so this chart you can refer to that whenever you wanted to have a quick look of the relationship, whether it existing or not existing, what is the position in the different requirement. One thing which I have not covered as part of the columnar presentation is what is the coverage of related party in respect of Ind AS 24. That is, company following Ind AS 24, what are all the things which we have to do? More or less, it is equivalent to AS 18. In addition to AS 18, Ind AS 24 also talks about domestic partner. So now we are trying to look at what is the various cultural changes which are happening. For example, marriage creates husband and wife relationship. Domestic partner living in relationship is also covered under Ind AS 24. So we are following Ind AS from IFRS. So whatever there, which creates some sort of a disclosure related issue, they are covering them here. Domestic partner, children and dependents of the individual, spouse and domestic partner. Children of the individual. That means if I am going in for reporting, I must first find out whether I have a domestic partner. If so, she is a related party. Second is when I am working out the numbers. Okay. So I am trying to find out whether it is relating to a domestic partner or children or dependent of the individual, spouse or the domestic partner, if I am following the Ind AS. So these are all the additional thing which you have to look at because of the cultural change which we are having. We have also borrowed from that. Section 222(e), I have already told you what is the coverage. Any payment by a company not being a company in which public are substantially interested. That means only private companies are covered. Any sum made after May 31st, 1987. What are all the transactions covered? Advance or nature of or loan to a shareholder who holds minimum or not less than 10% of the total voting rights, or he may be beneficial owner. He may be owner or beneficial owner of not less than 10%, 10% above. Okay. So in the voting power. Any concern in which such a shareholder is a member or a partner in which such has a substantial interest. For example, if I'm saying that I'm a member of a company, then I'm also a shareholder or partner in another company. So I'm falling into this to any concern in which such shareholder, that is the shareholder who is having already covered under your AS 18 or related party transaction under Ind AS 24. So in that particular scenario, we have to look at the relationship. That is the other concern in which the transaction happens also getting covered. Any payment by any such company on the behalf or for the individual benefit of any shareholder to the extent to which the company possesses accumulated profits. Interesting factor is there is an overriding principle under section 2 subsection 22(e). It says that if the company does not have accumulated profits or there is a shortage of accumulated profits, then in that case, the application of section 222(e) to treat that as a dividend in the hands of the recipient will apply only if that that company has profits or accumulated profits in the balance sheet. If it does not have an accumulated profits, it is having losses, then no transaction will be covered under section 2, subsection 22(e) of the Income Tax Act. 48(2)(b) defines the related party in a different manner, which I have considered here. If the assessee is an individual, what are all the items covered? But we are not talking about individual, right? So if we are talking about a company, then that person should have substantial interest in the business or profession of the client. Company, firm, or association of person, HUF, etc., which has substantial interest in the firm or profession of the company or any director, partner, member of such company, firm, association, etc., etc. If you look at that, this is the reason why I try to split the entire activity in three buckets: at company level, at management level, at individual level. Similar application you can also do for section 48(2)(b), and you can find out whether this is covered under 48(2)(b) or not. Okay, so there should be a substantial interest that individual or company or firm or whatever maybe should have. Similar to that is vice versa. Reporting entity is having substantial interest in another entity through a company, firm, or partners or Hindu undivided family, in which a director or partner or member of that particular company, firm, AOP, etc., is also having relationship with the other company. Any person who carries on business or profession, where the assessee being individual, they have talked about substantial interest, where the assessee being a company in which there is a substantial interest in the business or profession of that entity. So in simple terms, the individual should be having a substantial interest in the entity, or the entity should have substantial interest in the other entity. So that is a point. Section 56(2) of the Companies Act covers spouse, brother, sister of the spouse, brother, sister of either of the parents of the individual, any lineal ascendant or descendant, any lineal ascendant or descendant of the spouse, spouse of the person referred to in clause 2 to 6. That is, brother's spouse, sister's spouse, brother-in-law, uh, sister-in-law, etc., etc., are also get covered under 56(2) of the Income Tax Act. So this is the way in which the various parties are getting covered. Now the question is, what is the requirement of my audit process when I'm talking about audit of these transactions? The first point which I have to consider is, as I have said, the standards on auditing actually gives me the coverage requirement of the audit procedures to be followed and compliance requirement and the disclosure requirement, right? So when we were talking about SA 550 on this, what is the requirement of SA 550? How these transactions are connected? The first objective of SA 550 is to identify and understand the related party relationship and the transactions. The moment I say I have to first identify who is the related party, we have considered the entire list under the Companies Act, under the Accounting Standard, under Ind AS, under the Income Tax Act. We have identified the related party. Then, what is the transaction the entity is having with that related party has to be considered. The second aspect. The challenge is all this identification of relationship and the related party is based on the information available with the company or the reporting entity. That is the reason why, even when we were disclosing the related party transaction as per AS 18 or Ind AS 24, we always say it actually requires three disclosure, right? The disclosure A is name of the related party and nature of relationship. And B is transactions with the related parties during the year, aggregated at a reasonable level of various types of transaction. And third aspect is balances outstanding at the year end with the related party or by the related party. So these are all the three disclosure requirement as per AS 18, as per Ind AS 24, under the Companies Act. And of course, under the SEBI also, you require the similar disclosure to be made by a listed entity. Only thing is, additional requirement under the listed entity comes in by means of audit committee requirement, how the audit committee deal with the transaction, etc., etc. Right? But fundamentally, we have a problem in audit of identifying the related party and the nature of relationship. That is the reason why we always give a disclaimer. Institute is also giving WASB, when they have issued the guidance note on audit of even smaller entities, they have given certain guidances, and the guidance says that the related parties are identified to the extent the information is available with the company or the enterprise, the reporting enterprise. That means if the company has not received any information about a particular relationship with the director or key management personnel, or the relative of such director or key management personnel is having in another entity, company will not be at fault. So that's the reason why the standards on auditing says when you are identifying the related party and nature of relationship, you always say that it is based on information available with that company. The second aspect of the auditing procedure as per SA 550 says that what are all the risks associated with the related party relationship or transaction with the related party, whether that risk will be risk of material misstatement. So this is where I have said SA 240 is also talking about related party transaction are susceptible to fraud risk. And SA 550 is also asking you to assess whether there is any risk of material misstatement with the related party transaction or with the related party relationship, whether it is getting covered. That is the second requirement. So accordingly, every related party transaction should be subjected to a detailed audit procedure by the auditor in accordance with the SA 550 to as well as, of course, you can also apply the rigorous assessment of SA 240 fraud risk assessment as well. In fact, when we were talking about the various comments by the regulator, including NAFRA, we find that they are commenting that the auditor has not assessed the risk of material misstatement in accordance with SA 315. SA 315 says how you will assess the risk of material misstatement in audit. In that also, related party transaction occupies a important role or important place to be considered by the auditor. And then the regulators are also considering you have identified the risk of material misstatement in respect of a related party transaction, but you have not responded to the assessed risk by means of your audit procedure. There is some problem or negligence, or maybe your audit procedures are not adequate to check the related party transaction, whether they are arm's length, whether they are prima facie prejudicial to the interest of the company, etc., you have omitted to carry out. So SA 315, assessing the risk of material misstatement, SA 330, responding to the assessed risk, is also covered under SA 550 by saying assessing the risk of material misstatement due to related party transaction, as well as obtaining sufficient appropriate audit evidence about whether the transactions are properly accounted for, properly disclosed as per the applicable financial reporting framework. So, three aspects which we have said: identifying and understanding the relationship, assessing the risk of material misstatement with the related party transaction, and whether we have obtained sufficient and appropriate audit evidence relating to two aspects. One, they are properly accounted for. Two, whether they are properly disclosed. Okay. When their disclosure comes in, accounting comes in, they are referring to financial reporting framework. That is the reason why I talked about AS 18 and Ind AS 24. Again, we are talking about the related party transaction as per SA 550. It comes into entities having common control, key management personnel, close family members of the key management personnel, etc. That is coming in. So, what is the auditor's responsibility with respect to related party transaction? As I said, risk identification and assessment as per 315 in red with SA 550, related party identification and transactions has to be looked into. Whether any substantive procedures has to be carried out to identify whether the transactions are at arm's length or whether the transactions are unusual transactions in nature, suggesting that there could be a possible fraud risk. So 240 is covered, SA 315 is covered, 330 is covered. Then we are also talking about SA 550 relating to related party transaction. And what is the appropriate disclosure required should also be made, and whether the management disclosures are sufficient or not sufficient. Having said that, SA 550 requires the auditors has to document the work performed in complying with this SA 550. So documentation is an important aspect as per SA 230, right? So that requires the names of the identified related party and the nature of transaction entered with them. And what is the nature of relationship you have with them, that is also recorded. And what is the procedures performed to ensure that the transactions are genuine transactions, there is no fraud risk, and those transactions are at arm's length. If it is not at arm's length, whether it has been properly approved by the board and the shareholders of the company in accordance with the applicable laws and regulations. This is what we are supposed to look at. In doing this audit, SA 550 also says that we have to have certain discussion with those charged with governance. For a simple reason, we have to communicate that we have identified certain related parties in the current year, which was not considered as a related party in the previous year. We have to discuss and get their clearance also that yes, our assessment is acceptable, or if they are having a different view, why the different view is correct, our view is wrong, that we have to assess. We should also look at if there are any related party transaction entered into not in the arm's length, uh, not in the ordinary course of business. If the transaction is significant, that should be highlighted with those charged with governance. Okay. Um, Whether the transactions disclosure is fully complete or not complete, if they have any reservation on that, like I said, it's only based on information available with the company as on that particular time. So that should also be discussed with those charged with governance. So this is the communication, those with charged governance, there is a separate standards on auditing under which there should be a discussion on these matters as well. Okay. How the auditor should be prepared for validating, or how the auditor should be alerted to a possible risk in respect of a related party transaction. Normally, there could be a complex or one-time transaction with the related party for a significant amount, or there will be frequent transaction with the related party with a smaller amount. So ultimately, the aggregate amount is very high or significant, maybe by a single transaction or multiple transaction. Both are to be considered as a risk alert by the auditor in planning his audit procedures. Um, there could be transactions which may be happening with subsidiaries in other countries. So you know that there are certain financial frauds or uh, fraudulent financial reporting, whatever way you call, has been done through related party transaction, that too through the subsidiaries who are uh, not in India, out foreign country subsidiaries, because the audit may not be required in that particular country. Unaudited numbers are coming to the auditor. Auditor is consolidating that, and auditor makes a disclaimer in his audit report saying that these are unaudited, he has not audited, etc., etc. One recent expectation, which I should talk about to you, is that there is a divergence in the view on what is the position of the consolidation auditor in considering the report made by the component auditors. Assuming that I am going to do the audit report of the consolidated financial statement, there are multiple subsidiaries which are not audited by me, by some other auditor. So our SA 600 says we can actually make a disclosure under other matters paragraph saying that these are all the subsidiaries or associate or joint venture or other entities which we have not audited, and this has been relied on the audit done by the other auditors. That is what SA 600 says. But NAFRA has taken a divergent view, saying that you cannot escape by saying I'm not responsible when I sign a consolidated financial statement in respect of fraud happened in a subsidiary not audited by me. Very recently, it has happened, Cafe Coffee Day, in which the auditors have made a representation to NAFRA saying that you are questioning me for a material misstatement in the consolidated financial statement, but I have given a disclaimer saying that I have not audited the subsidiary at all. The issue was happened at the subsidiary level. You have to ask the subsidiary auditors, and you should not question me on that. That is what the auditors of Cafe Coffee Day has actually mentioned. NAFRA, based on that, actually the legal position is only like that as per SA 600 is concerned. So NAFRA is now trying to take a divergent view, irrespective of whether your SA 600 locally is talking about like this or not. The consolidation auditor should be held responsible for anything which happens in the subsidiaries, associate, etc., which is not audited by him. Because of that, also, we should always look at what are all the transactions which has happened in respect of the subsidiaries, associates, and other entities which are either in tax havens or in foreign countries, whether they are audited or not audited. If they are not audited, what is the additional procedure the auditor should perform to get his comfort on those transactions as well? To be the auditor's key risk indicator as well. Another interesting point is this also comes as part of your SA 240. SA 240 says management override of control is a fraud risk. And I'm saying management override of controls means what? 365 days, the control, or 364 days, the internal control system is operating effectively. But the management gives one direction to the finance team or the operations team, which overrides the control system and passes certain transactions. And I don't want to list out any case studies here, but you might be knowing in majority of the accounting scams which we have seen, in majority of the cases, the controls are overridden by the management themselves, and accordingly, the auditor could not found out over a period of time, and it is burst on a particular point in time, maybe after a long period of time. So, the SA 240 talks about you should look at all non-standard journal entries to ensure that there is no fraud risk involved. Non-standard journal entries will give you, because in an accounting system with the audit trail is available now, yeah, any transaction which has been originated and it has to be modified, you have to pass through a journal entry only. So those non-standard journal entries should be verified, especially for a related party transaction, to identify whether those transactions are genuine transactions or they are entered into with some sort of modified intention to make a fraudulent financial reporting. That's the way in which that also looks at the transaction. And normally the transaction with the related parties are significant single transactions, or maybe during the quarter ends or weekends, sorry, quarter ends or at the year ends, maybe to adjust the numbers which they wanted to have, management numbers. So any year-end journal, year-end entries or year-end high-level transactions which seems to be unusual, that should also be looked into by the auditors. So the question comes with respect of the standards and auditing. I can summarize to say that it has an interplay with the laws and regulations. Laws and regulations may be Companies Act, maybe Income Tax Act, maybe transfer pricing regulations, etc. In all these cases, SA 550 will be applied. Second is SA 550 has a direct linkage with SA 240, fraud risk related to related party transactions in an audit of financial statement. Then SA 315, as I have mentioned, you are supposed to identify the risk relating to material misstatement in an audit of financial statement through related party transaction. SA 330, whether you have carried out sufficient audit procedure to respond to the assessed risk on material misstatement through related party transaction. And of course, after everything has been happened, SA 700 audit report summarizes whether you got the audit comfort, you have a basis for opinion. If you do not have a basis for opinion, or if you are not received all the information required in respect of a related party transaction, whether you have to modify your opinion under SA 705 or 706, some emphasis of matter or other matters paragraph should be looked into. To summarize the entire thing, I can say that the SA 550 gives you a complete guidance on identifying the complete list of related parties. So how you will get that information? You inquire with the management with the list of related parties at the beginning, and then you look into the various forms declarations, minutes of the meeting, etc., to validate whether that is a complete list or is there anything which has been left out. So that is what the first level of validation. Then you are looking for identification of the various transaction entered into the related parties. And then the third guidance which is coming in is how to verify the existence and substance of the transaction with the related parties, whether they are in the ordinary course of business, whether they are unusual transactions, whether they are pass through non-standard journal entries, whether they are confirming that there is a management override of control, etc. And then making a disclosure of the related party transaction, name of the related party, nature of relationship, balances outstanding as per the various financial reporting framework, AS or Ind AS as the case may be. And along with that, what is the additional requirement required under the SEBI listing agreement as well. And of course, you should also confirm or communicate the significant transaction with the related parties, with those charged with governance, and what is your findings with respect to those related parties in case anything which you believe that which may require some sort of judgment. And of course, you have to document the entire record of audit evidence you have collected during the course of your audit. And lastly, but not the least, you may also ask for a management representation letter in which you are saying the list of related parties and the list of related party transactions which has been covered in the financial statements are comprehensive, complete list, and nothing is omitted based on the information available with the company. So these are all the things which SA 550 says, mainly because it talks about audit, it talks about compliance, it talks about the disclosure framework under various laws and regulations, including the Income Tax Act. With that, I think I have covered reasonably the requirement of SA 550. What I can now do is I can stop sharing this and look for the questions which may be given by the participants. Uh,
Yes,
Sorry.
yes, sir. Sir, first, we would like to thank you so much, sir, for such an excellent session and sharing your deep insights on related party transactions and covered all aspects related to India's standards on auditing and Companies Act. And sir, also the comparison table on related parties across the Accounting Standard, Companies Act, and Income Tax Act is very informative, sir. So, sir, we have received some questions from members. So, I request you to please take these questions.
Okay. So it is there in the chat box or what?
Yes, sir, I will read the questions and also put the question in chat box for your reference, sir.
Yeah, yeah. Because I'm not seeing anything in my chat box.
No, sir, there is a different admin portal where members ask the questions.
Okay, okay.
So the first question is the at the company level,
Hmm.
including joint venture and subsidiaries joint venture, and at the individual level, including KMP and their relatives, will all these parties fall within the ambit of the definition of related parties?
Yeah. So if you look at the company level, we are trying to find out whether it is a subsidiary or associate or joint venture. So that is at the company level. Uh, when I'm saying this, we are looking for whether there is control exercised by the reporting entity on another entity, or the reporting entity exercises significant influence on another entity. Vice versa is a possible. Another entity is exercising control or exercising significant influence on that. That is falling under your category of subsidiary, associate, joint venture, parent company, fellow subsidiary. Okay, that is at the company level you will identify. So they are falling in that definition. For a company, you cannot simply find out the related parties only as per the company level, you should also look at the key management personnel level or the management level. That is the reason why we are looking at whether there is any transaction with the director or any transaction with the key management personnel or any relative of the director or key management personnel. That is also comes into the picture. The various categories which we have talked about: firm, private limited companies, public limited companies, etc. In public limited companies alone, the 2% is coming into the picture. Okay. The second question, I think that if an employee who serves as a director in a fellow subsidiary is appointed as an independent director of the holding company, and the terms of his or his appointment involves non-cash transaction, would such non-cash transaction require the approval of the shareholders of the holding company? uh, Let me assume in this transaction that the director of in a fellow subsidiary, there also he is an independent director, and here also is an independent director, will change the position. So if it is a transaction in that particular scenario, as an independent director, he cannot enter into any non-cash transaction with the company. So accordingly, that will be totally outside the purview of even as an example. But the second possibility is in the fellow subsidiary, he is a director who is a non-independent director. That is what, but he is appointed as an independent director in the holding company. I must tell you that it will never happen, because the relationship when you are enjoying with the holding company or the subsidiary company or the companies under the same management, automatically you are not an independent director. Accordingly, that will not get covered. So in this scenario, even though you are calling him as an independent director, he cannot be an independent director. He will be considered as a non-executive, non-independent director. But if there are any cash transaction, which is as a non-cash transaction is happening, that definitely requires the approval of the shareholders of the holding company as well.
Okay. And so the next question
So
is
during the audit of private limited company, the auditor noted several high-value purchases from a related party of the company. However, there was no documentation showing that these transactions were reviewed or approved by the board. Interesting. The first thing which we have to look at, because it's a private limited company and there are certain exemptions available for a private limited company, you have to first look at whether they are done during the ordinary course of business. Suppose if it is an ordinary course of business, the next check which they are asking you is whether it is arm's length price. Then no review by the board, no review by the shareholders, nothing is required, because that transaction is an exempted transaction because normal course of business and at arm's length price. Let us assume that it happens either not during the ordinary course of business, or it may be during the ordinary course of business but not at arm's length price. Then definitely the board has to consider, because in a private limited company, audit committee will not be there. In that case, board has to necessarily consider this for approval of the transaction. Okay, we have to look into that aspect, whether it falls under exempted transaction or not exempted transaction. Okay, if it is a not exempted transaction, board approval is required, because audit committee is not normally prevalent in respect of a private limited company. Yeah.
and said the next question during the
Yeah.
audit of
During
private.
the audit of a private company, the auditor noted several loans or advances to a company wherein the managing director's spouse hold 95% of equity shares. These transactions were not disclosed in the related party register and had no formal agreement or repayment terms. A clear case of violation of not only related party transaction, but 195, Section 195 of the Companies Act also says that a private limited company cannot give a loan to a director or a relative of a director. That is still considered as prohibited loans. Even by passing a approval by the shareholders of the company, it cannot be cued. So it will be a clear violation. So if they are not reported by the company, it is non-compliance with the SA 550, non-compliance with the SA 18, because it's A is 18, because it's a private limited company. I assume that its net worth is less than 250 crore. And another point is loans and advances, if it is not given directly to the spouse, but to a company wherein the managing director spouse is holding shares, whether that is exempted or not exempted from the application of Section 195. If you look at that, just because two entities are having common shareholders or common directors, Section 195 will not apply. Uh, you have to look at whether that is permitted by means of a special resolution, because it is not directly given to the director or to the spouse. It is only given to a company in which the director or spouse is holding significant influence. Still, my feeling is Section 195 is violated. Related party transaction anyway is violated. That is different. 195 violation also you have to consider in reporting. Maybe in your main audit report itself, you have to consider depending upon the volume of the transaction. Is a company required to report CSR expenditure incurred through a Section 8 company that has a common trustees or directors with the reporting company? Previously, we were having a feeling that it is a CSR activity, and accordingly, we need not make a disclosure, but the guidance note on CSR issued by the institute has required specific disclosure in which they are saying CSR expenditure incurred through related parties has to be disclosed. So that means if we are carrying out the CSR activity through Section 8 company in which the directors are also director there, that should also be covered as a disclosure requirement under CSR requirement, not only AS18 disclosure. I normally what I do is that in related party transaction, I will say corporate social responsibility expenses incurred through the trust, I will disclose that. And in the Schedule 3 format, where we are talking about the corporate social responsibility expenditure in three clauses are there: 1, 2, 3. What is the amount to be spent? What is the various categories of amount heads under which the expenditure has been incurred? Then whether there is an excess or shortfall. And lastly, you also have whether any amount has been spent through related parties or paid to the related parties. In that, normally I give a cross reference to the related party disclosure. So you can also do that, but it's a mandatory requirement.
Thank you, sir, for taking these
Thank
questions.
you. Thank you so much.
And I also thank you to all the participants for such an interactive session. Thank you,
Okay.
sir.
Thank you.
Thank you.
Bye.
Bye, sir.